Welcome back to Trading Basics with Jared Roboski. This is volume 9, and we're going to discuss risk management. Risk management is the most important topic when trading. Every time you enter a trade, you have to know where you're wrong. And that's what makes that's what sets the difference apart between a professional trader and a gambler. Most people think that trading is just gambling, and it is if you don't have any risk management. So let's look at some risk management tools and some ways you can look at this. Now, every time you enter a trade, you need to know what your plan is for that trade. And you should always do a risk reward analysis. And your risk versus reward should be a good baseline is about 3 to 1. So your reward should be 3 times your risk. So if let's say on this chart right here, this is the SPY, price is at 392 right now. Let's say I'll take this, but I don't want to risk more than $1 on this trade, right? So if I'm going to risk $1, I need to be able to make $3, right? So if I'm taking this, I'll take this trade. I mean, it would have been perfect to get it right off of this 200 exponential moving average right here. Perfect buy. And then you could risk, not saying you have to get out once you have 3 times your necessary risk. Just know what your reward is, and don't take a 50-50 risk reward, right? Don't risk $1 to make $1. Don't risk $1,000 to make $1,000. You don't want to do that. You will lose all of your money over time. Now, if you have a tight risk reward strategy, over time you could be right half the time. Flip of a coin, and with proper risk management, you will be a profitable trader. So let's look at how you would manage risk if you were going to enter this trade, or if I was going to enter this trade. We've got to bounce off this 200 simple moving average. So that is the easiest place to manage risk from right here. If you wanted to, it's already made a lower low than right here. So you are in a little bit of a downtrend, but generally in a downtrend, you're still going to get a bounce. Remember when we talked about moving averages just a couple videos ago? Look at all these bearish crosses we have right here. So what's most likely going to happen when we have a bearish cross? Price action will get pulled back into that to confirm the cross. So if this is truly going to be a bearish move to the downside, I'd like to see price action pull back into these crosses, somewhere around this range, and then get rejected again, and then make another lower low. Because what that would do is put in a lower high. If it came up to here, this high would be lower than this high, and it could continue to the downside. But let's say you want to go long right here. Easy place to manage risk would be right here at 391, right where that 200 simple moving average is. If you had a little more risk and you were looking to play it a little bit higher, you were looking to take this bounce all the way up here, then you might set your risk down to 390, right? You're willing, but as soon as this crosses, you're wrong. You have to get out. And that's number one when trading, is just to know when to admit that you were wrong. And you're going to be wrong quite often. So it's very what generally happens, and this is why most people lose money, is emotion will set in. Let's say you were buying right here because you thought, oh, it's going to put in another higher low. Let's hide these and show, okay, you were looking at this and you said, you know what, we got this little trend line here and it looks like it's putting in this formation. So let's say you bought right here. thinking it's going to bottom out here and bounce again like it did these previous times. And I'm sure a lot of people did buy here. As soon as this next candle closed below your trend line, that was your signal to exit that trade. You were wrong. If you were long, you were wrong. The way you could have done it as well is immediately exited that long position and flipped short right here. And then you would have been in profit on the way down. Just something to think about. And then again, you would manage your risk on that short with this line. If we close back above that line, you were wrong on that trade. You have to exit that trade. And that's really the key to being profitable, is to admitting when you're wrong and exiting that trade quickly. You want to let your winners run, and your losers, you got to cut them short. And it's very easy to say, but it's not as easy to do, and you will find that out when you're in a trade. Because what's happening, guaranteed, a lot of people that went long here are still holding. And what they do is they start making excuses. Okay, we made a lower low than there, but we haven't gone lower than here. And what they'll do is, if this was their support line, they'll move it down. If you do that, you will lose all of your money, guaranteed. And then what will happen if this breaks down and breaks this line? Human emotion, they'll start looking for the next target. They'll say, oh, well, it topped out here, around there, and then we gapped up and opened here. So I'm going to move my support down, and as long as it doesn't break there, then I'm good. Don't do that. You will lose all your money. So stick to your guns. If your support level breaks, you exit the trade. And also, position sizing is a very important topic when it comes to risk management. And position sizing means using the correct size of position that matches your risk tolerance, right? If you have $10,000 in your account, do not go take a $10,000 trade unless you really know what you're doing. You shouldn't be risking all of your money on any one trade, right? And I'm not saying you would take that trade to zero or anything like that, but you shouldn't use your entire account for one trade. So find out what your risk tolerance is first based on a trade. How much conviction do you have in that trade? What's the setup? Are there multiple things lining up? Or are you about to take a trade just based off of this little line here, right? Because a little trend line is only one confirmation. To have a sure trade, you would want multiple confirmations on that trade. So something that I look at is I have multiple indicators that I'm running down here at the same time, right? So I'm going to look for multiple confirmations. Something I do like here about going long, this would be a good area to go long, and I'll do that as soon as I get off this video. But we got the 200 simple moving average here. We got the hourly Stokes wiggling at the bottom. We got RSI down here at the bottom, right, in an oversold territory. And then we have BBWP. That's a volatility indicator. Volatility is very high. So that tells me that most likely this move to the downside is going to stop going to the downside, at least for a little while. We'll probably bounce back up and maybe at least test this little yellow line or touch this this 10 moving average right here, this red 10 moving average. So you probably do get a little bounce here, and then most likely continue to the downside. But either way, that's a little bit how I manage risk, and we'll get into more details in the advanced videos, and I'll show you how I manage risk on actual trades and use a stop loss. Let's jump in and see what that stop loss is real quick. So here is that Webull again. And remember, on these order types, you have a stop. And what that stop order is, let's say you wanted to enter a trade here at 334, and you said, I'm wrong at 332. Well, you can place a stop order right there at 332, and then your position will automatically close when price gets there. That way you can take the guessing out of it. If you notice that your emotions are getting the best of you and you're not exiting trades when you were wrong and you should have exited, then go on ahead and use a stop loss and exit that position. Another good time to use a stop loss is if you're traveling, you're going to be away from your computer, you're just not looking at it all the time and you're not watching price action. Stop losses can be excellent for that because it's going to minimize the loss that you could take on any given trade. It's also good to sleep in a stop loss. If you're trading Bitcoin or cryptocurrencies that trade 24 hours a day, you're going to want to use a stop loss when you go to bed, or else you could wake up and the price went down a lot and you lost a lot of money in your sleep and you can't watch the charts in your sleep. So make sure to use those stop losses. We'll get into some more advanced strategies on how to use those in some later videos. Thank you so much for joining us on this video on risk management. And our next topic will be on some trade strategies. We'll discuss scalping and swing trading. Thank you so much. You have a wonderful day.